to today's Daily Dose of Market Insights. Very good morning. Today will be the Friday, the 12th of September 2025. So as usual, before we jump straight into today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick look first what has taken shape yesterday, as well as in today's early Asia session in terms of the relevant news flow, economic data releases that has a significant impact on the intraday movement of all those broad-based cross-asset classes that we covered on a daily basis, which is the movement of the four major US dollar pair, the six major stock indices, and as well as the two key commodities market, which is gold XAU/USD and the West Texas crude oil. So let's start what has taken shape yesterday. So yesterday we do have two key risk events that has shaped the intraday performance of the broad-based cross-asset classes. Will be ECB and as well as the release of the US CPI data. So let's start with ECB first over here. So ECB, as expected, kept its policy interest rate unchanged, which is the depo rate at 2% after it undergo or did a 8 interest rate cut in Eurozone since June 2024 last year. So what most important, what is the outcome of the monetary policy guidance going forward is that there's right now a very high chance that ECB is almost done with this 8 interest rate cut that they have did so far. So how do we know that? Is by the speech on last night or last evening at 8:45 p.m. from ECB President Lagarde. So ECB President Lagarde over here, based on her speech, right now the futures traders in the Eurozone short-term interest rate market is now raising bets or starts to price that ECB is almost done on its interest rate cut cycle over here, because during the press conference, ECB reiterated that the bank remains in a good place and say the risk to the economy has become more balanced than before. So what it means that there is lower risk to actually create a negative demand shock to the Eurozone economy. And what's interesting over here is that yesterday, they also released their latest economic projection for the Eurozone over here. So the latest economic projection for the Eurozone, especially on GDP growth, they have upgraded 2025 year-end GDP forecast to 1.9 to 1.2%. All right, so that is a 3 basis point increase from the earlier forecasted figure at 0.9%. So they believe that the GDP growth in 2025, by the end of 2025, will be revised to the upside as compared to the previous projection. So that's actually positive in terms of how they view things from the demand side of the story by ECB officials. And what they also mention over here is that they also do a slight upgrade of inflation, the headline inflation. So headline inflation, they actually raised their forecast by the end of 2025 to 2.1%. From 2% previously forecasted in the previous meeting, and also raised their forecast for 2026 by 1 basis point to 1.7% from 1.7%. But however, it actually reduced 2027 forecast by 1 basis point to 1.9% from 2%. So that's just a slight decline. And they maintain the core inflation rate that's stripping out the volatile food and energy component the same for 2025 at 2.4% and 2026 at 1.9%, and slightly downgraded slightly one lower for 2027 at 1.8% to 1.9%. So there is actually it doesn't, this latest inflation forecast, if you look at it as a whole, done, does not indicate a clear risk of a deflationary spiral in Eurozone. So that actually causes the short-term interest rate futures in the Eurozone to actually increase bets that ECB is almost done with cutting rates. So that also actually support the euro dollar as well, where the euro dollar actually what we could see is that based on our yesterday's intraday technical analysis outlook on the euro dollar, it bounced off right exactly at our 1.675 pivotal support that we highlighted earlier, which is so the 20-day and the 50-day moving average. And so on top of this, ECB President Lagarde more firm up monetary policy guidance that ECB has more or less done with their interest rate cut cycle. On the US side of the story, the US market short-term interest rate futures are now pricing in continuing high chance that the Fed got to actually undergo or start its Fed dovish pivot instead rather than hike. So they will actually kick or stampede. So right now the Fed has been maintaining an unchanged stance since the start of this year by not cutting rates. And the next upcoming meeting next week, they will start to cut rate, and subsequently there will kickstart a interest rate cut cycle going forward into 2026. Later I'll share with you what do I mean by that. So one more data that came in over here is the core CPI data for US. So both on a month-on-month basis, the core CPI data came in within expectation. So month-on-month market is expecting at 0.3%. So it came in exactly at 0.3% at the same rate as of the previous month of 0.3% in July. Similar, if we look on from a longer term basis, that means year-on-year basis by stripping out the seasonality effects. So year-on-year basis also came in within expectation, 3.1%. As previously as well, also at 3.1% previously in the month of July. So same rate of growth, but still hovering above that 2% target that the Fed desired. So right now, market participants now is more concerned about a weakening of the US demand side of the story, weakening of demand led by softening of the US labor market that outweighs the risk of sticky inflation. So that's why market participants in the Fed funds futures market is placing more bets for a Fed dovish pivot to kickstart rather the Fed to maintain its wait and see guidance that has been taking shape since the start of this year. So one more data, it's not really a tier one data, tier two labor market data. But this data is quite volatile because it released every week. Is the weekly initial jobless claim. So weekly initial jobless claim in the US for the week of 6th of September, it rose more than expected. So it rose to 263K from what market is expecting at 235K. So it actually jumped up quite very significantly. And this jump of 263K for the week of 6th of September is the most since October 2021. So that's close to about a 4-year high. So with that, market participants continues to price in a dovish Fed that has been late in the game. And what we could see right now is that if we go to the current rate, for sure, 100% chance that the Fed is likely to cut by at least 25 basis point on 17 on September to bring it down to 4% to 4.25%. And right now there is a slight chance of 7.5%. So this 7.5% is it came down slightly lower after the release yesterday of the initial jobless claim and the core CPI data. So a small chance of 7.5% that the Fed funds futures traders are betting that the Fed will do more by 50 basis point cut. But I don't think they were able to do by 50 basis point cut. And they also do not want to send a strong signal to market participants that the US economy is deteriorating in a very bad shape. So if they start to cut a 50 basis point cut rather than a 25 basis point cut, yes, the dollar will weaken, but it could create a negative feedback loop into the major US stock indices because sending out a much more signal to the market participants that the US economy is more in a bad shape. All right. So I don't think they will actually do a 50 basis point cut. So I'm skewing towards more of a 25 basis point cut. But what's interesting over here is that on the aggregated tab, what we could see is that this is the probability on all the futures Futures Federal Reserve FOMC meeting, stretching all the way down to next year, 9th of December 2026. So very clearly, what we could see over here is that by looking at the turquoise blue boxes, Fed funds futures traders is now pricing in a start of a fresh new interest rate cut cycle in the US. So in the next two subsequent meeting in 29th of October this year, the Fed will do another 25 basis point cut, as there's a high chance of 93% to bring it down to bring down the Fed funds rate to 3.75% to 4%, and another 25 basis point cut before the year ends on the 10th of December 2025 FOMC meeting. 86% chance, which is also a high probability as well, to bring the Fed funds rate down to 3.5% to 3.75%. So right now, there are high odds of more than 60%. The Fed funds futures traders have started to price in at least 3 interest rate cuts starting from the 17th of September next week of 25 basis points each. And also subsequently, there will be a series of interest rate cut in 2026 as well. By the end of 2026, the pricing of the Fed funds futures market is now looking at the Fed funds rate to end lower 2.75% to 3% by the last meeting of 2026, which is the 9th of December 2026 FOMC meeting. So that created a weaker dollar. And if you look at the US dollar index, which I mentioned earlier on, that there's this key support level that we got to watch out very closely, which is this 97.3, where yesterday there is a bearish reverse candlestick price action right after the intraday test on the 50-day and the 20-day moving average on the US dollar index. So right now, after that sell-off yesterday, in today's early session, there's a bit of profit taking in the FX market, where the US dollar starts to bounce by 0.15%, but I view this bounce is more like a corrective rebound. By looking at the price action on this US dollar index over here, this seems to be like a like a bearish head and shoulder formation over here. So this is the head, this is the left shoulder, and this is the right shoulder with the resistance at 98.95. So the key support level will be 97.3. So if we have a monthly close below 97.3, potentially we could kickstart a much more structural, longer term, multi-month downtrend on the US dollar index, which means represent a broad-based dollar weakness on a pronounced basis. So this 97.3 very important. Why? Because it's the lower limit of this long-term circular ascending channel support taken from the low of May 2011 low over here. All right, so that's for the FX market. And due to the fact that because right now we start to see a much more clearer signs of the weakening on the demand side of the US market, prompting the Fed to actually now kickstart a fresh interest rate cut cycle after being on hold for the entire year so far. It actually lead to those laggards being the outperformer yesterday, especially the Dow Jones Industrial Average and the Russell 2000. Yes, all four major US stock indexes closed in the green. The SPX and the Nasdaq 100 continues to do fresh all-time high, up 0.85% for the SPX, the Nasdaq 100 up 0.6%, and the top performer yesterday is the interest rate sensitive Russell 2000 and the Dow Jones. These two indices has been lagging behind since the start of this year, and even since the medium-term low of the this April low, where Trump announced that global tariff on Liberation Day. So the Russell and the Dow Jones is doing a catch-up. So very interestingly, the Dow Jones Industrial Average yesterday, I shared with you guys in my intraday technical outlook, stating that we are now poised for a bullish breakout from this minor bullish ascending triangle range. Indeed, it did that bullish breakout above the range resistance of 45,780, 45,690, and now pierced into a fresh all-time high region. So for today, given that the off is in the overbought region, so there could be a bit of minor pullback. So pivotal support level to watch will be at 45,780, 45,690 on the Dow Jones Industrial Average, which is in our platform, we call it the US Wall Street 30. So what's interesting is that now we have one of the laggard making fresh all-time high. So the Dow Jones down doing fresh all-time high. The next laggard that hasn't made fresh all-time high is the Russell 2000. So if you look at the Russell 2000 chart over here, the fresh all-time high was 2,458 or 2,459 previously. It was tested in last year, late November, ex-post US presidential election, where Trump won. can't maintain that momentum, and it did that corrective, we call it wave, corrective decline wave that lasted for about at least 4 months or so before shaping this ongoing medium-term uptrend. So net overall, what we could see over here is that this is the current all-time high of 5th of November 2021. So it seems to us that at this moment in time, the momentum still remains strong for this Russell 2000. So this could be the next potential US major stock indices, the small cap, to actually undergo a revival of a bullish momentum that could allow it to potentially breach above the current all-time high of 2,458. So if you look at the current the daily RSI over here from a technical perspective, so the daily RSI continues to shape higher low, hasn't hit the overbought level yet. All right, so indicating momentum on the medium term basis still remains rather positive for the Russell 2000. That's the small cap. All right, so that's for the US stock market and the FX market over here. So coming to Asia over here, we know that if we start to see a softer US dollar over here, it will be beneficial to Asia Pacific benchmark stock indices, which indeed true. So the Nikkei 225 continues to actually bask in the bullish limelight, up 0.73% today over here, and the Hang Seng and the index also up by 1.27%. And going forward to the rest of the other Asia region, the China A-shares benchmark CSI 300 index that consists of both the Shanghai and Shenzhen composite stocks down slightly to negative 0.3%. And our local STI is a bit of profit taking right now, negative 0.3%. Kospi, the Korea benchmark index, is up by 1.6%. The TAIEX is up by the Taiwan stock benchmark stock index up by 0.7%, and over at the ASX 200 is up by 0.7%. So net overall is more positive. That is being seen on the Asia Pacific stock market, riding on the cocktails of a much more dovish Fed that market is now looking at, starting from 17th of September next week FOMC meeting over here. So that's cover the first segment of the daily dose. So one more segment I share with you guys, I forgot to share, is the oil price. All right, so what I could see over here is that oil price continues to remain lackluster. So those who recall in my daily dose or market insight yesterday, in my daily outlook for West Texas oil, I keep a lookout for that 20-day moving average. So this 20-day moving average on the West Texas oil indeed act as a bearish reaction zone, which is 64.10/64.36. Bear in mind that yesterday I do highlight that whatever rebound that we see at the start of this week is corrective in nature, whereas the minor trend and the medium-term trend on the West Texas oil is still skewed towards the downside. And indeed, it broke below our first support at 62.95 and heading towards our second minor support area that we highlighted yesterday at 61.85. So given that it's now hitting 61.85, which is the low of last Friday, and the RSI is at oversold territory, so there could be a minor bounce taking shape in West Texas oil today. And given that today is the last trading day of the week, so potentially there could be a minor bounce. So first minor bounce will be at 62.95, resistance to watch out for. The short-term pivotal resistance remains the same because it hasn't broken below 61.85. So unless we have a clear break below 61.85, then the pivotal resistance will be at 62.95 for today. Next support level to watch will be 61.30 on West Texas oil. So why West Texas oil is so weak despite that geopolitical risk tension that market has now no longer put in place is because yesterday we do have this IEA, we call it forecast for the US, expecting oversupply to increase with OPEC output boost as well. So that potentially could actually lead to much more supply going to the global oil market, keeping a cap on whatever geopolitical risk tension that the market is actually witnessing right now after that so-called unprecedented, we call it Israel attack on Doha, claiming that there is Hamas leadership gathering in other sovereign nations outside Gaza, and also that unprecedented incursion of Russian drones into Poland that were actually prompted NATO to reassess their stance towards Russia. All right, so that it has been fading in the background, and right now the technical picture seems to be supporting a much more weaker West Texas oil price by those levels that I shared with you guys. All right, so gold also remains firm as well, given the fact that the dollar is weak over here. So gold over here is that yesterday gold did a bullish reversal right at our support level that we highlighted, 3,620, with the key pivotal support level at 3,600, indicating that deep buyers are coming back into the market. And also momentum remains strong, where we start to see a bullish momentum breakout on this RSI, hourly RSI momentum indicator, where it broke above a parallel ascending trend line resistance, now turns into a pullback support and hasn't hit the overbought level as we are speaking right now. All right, so that's some of the first segment of the daily dose. All right, so let us now move on to the second segment. So for today, I will just do a chart of the day, given that it's a Friday. So before I share what is the chart of the day to look out for, let me expand my screen very quickly so that you guys could have a better view of the chart. So today, chart of the day to look out for will be in the FX market over here. So it will be the Aussie dollar. All right, so still recall Aussie dollar, we do have a bullish bias since the start of this week. So right now this Aussie dollar continues to trade firmly within this accelerated minor ascending channel phase since the low of 4th of September, and right now it's actually fast approaching a key resistance level at 6660/67 figure level. So why is this level so important? Either that is being a minor Fibo extension cluster level, which I highlighted yesterday, and also the upper limit of this minor ascending channel taken down from the low of 4th of September. This 6660/67 figure is in fact a major resistance level over here, 6660, 6670 on the daily time frame chart. So this level coincides with the upper limit of this ongoing expanding wedge that is be in place since the low of 24th of April this year, and as well as a long-term descending trend line from 25th of February 2021 high, this pink line here. And what's interesting over here, upon this test of it right now, we start to see very strong momentum reading on the daily RSI. So daily RSI staged a bullish breakout over here, as highlight bullish breakout, the time twisting just now, as highlighted by this green box over here, and hasn't hit the overbought region yet, indicating that bullish momentum still remains intact, potentially indicating a high chance that it may do a major bullish breakout above 6660/67 figure on the Aussie dollar. So now back to my daily time frame chart. So in my back to my hourly time frame chart. Pardon me about time twisting. So just now was the daily time frame. Now going to the hourly time frame to decipher the minor movement for today. So the minor movement for today, there could be a potential minor pullback taking shape first before that bullish breakout occur above 67 figure level. Why? Because of the hourly RSI has already just exited from the overbought region, but upon exiting from the overbought region, there is no bearish divergence. Price action going to shape higher high, so indicating only a minor pullback rather than a bearish reversal. So with this minor pullback coming into the picture of the hourly chart of the Aussie dollar, so we will still maintain that bullish outlook on the Aussie dollar on the intraday basis, but there will be a risk of a minor pullback first. So minor pullback, two key support level to watch for today will be 6635 followed by 6520, which is the lower limit of this minor ascending channel lower limit from the low that I draw from a 4th of September low. And if we do the Fibo retracement of this ongoing accelerated uptrend from the low of 4th of September all the way up to today's Asia session high, that also coincide with the 23.6% Fibo retracement. So as long as this minor pullback didn't surpass below 6520, thereafter there could be a continuation of that potential bullish momentum of Aussie dollar to seek out another a bullish impulsive up move sequence to test 67 figure level. Above it, potentially seek out 6750 next, which also is a 0.36 close to 3.618 Fibo extension over here, and also this is the October high last year as well. All right, so net overall still maintaining that bullish bias on the Aussie dollar on the intraday basis after that minor pullback has taken shape. All right, so that's for my chart of the day for today. So with that, now let me cover the last segment of the daily dose. So last segment of daily dose today, very quickly, what will be the key things to look out for today? So today key event on Friday, 12th of September, will be the UK monthly GDP for July. That will be out at 2 p.m. Singapore time. So that could potentially influence the movement of the sterling dollar, the sterling crosses, and in some form the UK 100 CFD index. Then going forward into the start of the US session, we have the all important tier one economic data as well, which is centered on the demand side of the situation, or the demand side of the US economy, which is the University of Michigan Consumer Sentiment preliminary data for the month of September. So market is expecting a slight dip to 58 from 58.2. So if we start to see a further slowdown below 58, let's say around 50, 56 or 55, that could indicate demand weakness in the US, given that consumer sentiment is a leading indicator for retail spending. So that could actually prompt more bets of more future interest rate cuts from the Fed going forward into 2026. All right, so that sum up today's daily dose of market insights. I wish you all a great day ahead, and as well as a wonderful weekend, and we shall speak again on next Monday. Thank you.